Welcome to the deep dive. Today, we're really jumping into the world of Warren Buffett's investment strategy. It's often seen as this, shortcut to being smart about finance, but it's more than just stocks, right? It's this big shift in thinking, like viewing a stock as actually buying a fractional ownership in a business,
Hmm.
not just, a piece of paper to trade. And it brings us to that famous line, price is what you pay, value is what you get.
Exactly. And that's not just a catchy phrase, it's a core discipline. That mindset, the business owner mindset, it forces you away from just watching the ticker tape, the daily noise.
Yeah.
Instead, you're looking at the actual business, its earnings, its assets, trying to figure out what it's really worth, separate from market mood swings. So our mission today, let's unpack his approach, his genius really, and see how you might apply some of these ideas.
Okay, let's do it. Where do we start? The foundation, I guess, has to be Benjamin Graham. His influence was huge, wasn't it? Especially this idea of Mr. Market. It's such a vivid allegory. How does that work?
It's brilliant, really. Graham basically said, imagine you have this business partner, Mr. Market, and he's manic depressive. Every single day he shows up and offers to either buy your share of the business or sell you his. But the price, he quotes, it's all over the place, totally driven by his emotions, euphoria one day, despair the next, not by the actual value of the business. And Graham's point, which Buffett grabbed onto, was that Mr. Market's mood swings aren't a risk you should fear. They're an opportunity. If you stay rational, you can use his moods to get, not to be missed prices.
Ah, okay. So you ignore his mood swings, unless they offer a bargain. Don't let his panic become your panic.
Precisely. You use his volatility to your advantage.
And that connects right into the margin of safety, doesn't it? Buffett calls those the three most important words in investing. How does that work as a safety net?
Absolutely. Margin of safety is key. It just means buying something for significantly less than what you calculate its real underlying value, its intrinsic value to be. It's not just about snagging a deal, though. It's a buffer. It protects you if your calculation is a bit off or if things go unexpectedly wrong with the business or the economy. Buffett uses that analogy of a bridge, right? You want to drive your, say, 7,000-pound truck over a bridge built to hold 10,000 pounds, that extra 3,000 pounds. That's your margin of safety. It gives you confidence, makes the whole thing much less risky.
Got it. Makes sense. So how did this all shape Buffett's own path? Because the early Buffett, he was different, right? The cigar butt investor.
Yeah, the early days were very Graham-like, finding these sort of discarded cigar butts, companies that were, frankly, pretty mediocre, maybe even declining. But they were so cheap, often selling for less than their liquidation value. You could buy them, hope for one last little puff of profit, and then get out.
Okay, find a bargain, get one last bit of value. But then Charlie Munger comes along, and this seems like a huge turning point.
A massive one. Munger really shifted Buffett's perspective with that famous line. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Mm.
It sounds simple, but it's profound. Munger helped Buffett see that those super cheap cigar butts, well, sometimes they're cheap for a reason. They might just keep declining. But a truly great business, even if you pay a fair, maybe not rock bottom price for it, can compound its value year after year after year. Over the long haul, that's where the real wealth is built.
So shift focus from cheapness to quality. And that brings in the idea of the economic moat.
Exactly. The moat. It's that durable competitive advantage, something that protects the company's profits from competitors. Like a moat protects a castle. Think about powerful brands, like Coca-Cola. Everyone knows it. That's a moat. Or, and this is a big one, high switching costs. How difficult or annoying is it for customers to switch to a competitor? If it's a real pain, that company has a strong moat.
Okay, let's make this concrete. The Apple investment starting in 2016. That surprised a lot of people because Buffett usually stayed away from tech. How does that fit this evolved strategy?
Right, people were surprised, but if you look closely, it makes perfect sense through this Munger-influenced lens. Buffett said he saw Apple less as a tech company and more as a consumer products company, one with this incredible franchise. The moat wasn't just the iPhone hardware. It was the whole ecosystem, the App Store, iCloud, how all the devices work together. It's incredibly sticky. Switching away from that ecosystem for many people involves high costs, both in terms of money and hassle. That's a powerful moat.
And the management played a role too.
Definitely. He saw Tim Cook and the team exhibiting what he calls rational capital allocation. They weren't just sitting on cash. They were returning huge amounts to shareholders through buybacks. Plus, at the time he started buying, the market was a bit pessimistic about Apple's growth. So, Mr. Market was offering a wonderful business at what Buffett considered a fair price. It ticked all the boxes of his evolved approach.
Okay, this all sounds logical. But applying it, that seems like the real challenge. You said the biggest hurdle isn't the analysis, it's psychology.
Yeah, I mean, the analysis is hard work, no doubt, but the really hard part is your own mind. We're constantly bombarded with news, opinions, market chatter. There's that fear of missing out, FOMO, staying patient, being disciplined, keeping your emotions in check when everyone else is freaking out or getting greedy. That's incredibly tough. That's why Buffett always emphasizes temperament. He genuinely believes your emotional makeup, your ability to stay rational, is more important than pure IQ for investing success.
So buy and hold isn't just set it and forget it.
Not at all. That's a common misconception. It's really buy, hold, and monitor. You have to constantly ask, is the business still wonderful? Is that economic moat still intact? Is management still rational? Because things change, competition arrives, technology shifts. Even great companies can falter. Buffett himself has made mistakes. He talks about Dexter's Shoe Company. He bought it, thought it had a moat, but foreign competition eroded it, and he missed it. Yeah. He paid a high price for that lesson. So yeah, you hold, but you keep watching. You have to be willing to admit when the story changes.
Right. So at the end of the day, Buffett's legacy isn't just a list of stocks he picked. It's this whole framework, this philosophy for thinking about businesses and risk.
Exactly. It's a timeless approach to managing risk and building wealth over the long term.
So the question for you listening is maybe not, can I pick stocks like Buffett, but something deeper.
Maybe it's Gal. How can you cultivate that rational temperament, that business owner mindset? How do you apply that discipline to your own financial decisions, especially with all the noise out there today? Remember the goal. Find a wonderful business. Ideally, hold it forever. But crucially, only as long as it stays wonderful and the price makes sense. That's the ongoing challenge.